Hey everyone, me Kevin here. Wow, the Swiss move really fast. So remember, Credit Suisse, massive potential bankruptcy risks and contagion risks. Credit default swaps were pricing in massive premiums this morning, 1,000 bip premiums. I mean, we had some insane quotes this morning, and you won't believe what the Swiss basically version of the Federal Reserve just did. But let me give you first a little bit of a breakdown. So a lot of the crisis today in Credit Suisse's stock was caused by the Saudi National Bank, the largest shareholder of Credit Suisse, declining to increase their stake. That led to massive fear and pandemonium. They were blaming a regulation, saying, we don't want to go above a 10% stake because then we'll be subject to more regulation. That was sort of their excuse for not investing more. But everybody's like, no, you don't want to throw any more good money after bad, especially during a liquidity crunch. That led to a lot of freak out this morning. I mean, we had quotes like, quote, the collapse of Silicon Valley Bank feels like a death in the family for the tech community, and now we've got Credit Suisse. That was Sequoia Capital. You've got quotes this is the next shoe to drop, and this one is systemically important and too big to fail. This is really bad. However, we did just get a very, very large update on Credit Suisse, which, keep in mind, the size of Credit Suisse, we're talking about $580 billion of assets under management. That is substantially different from what you have with Silicon Valley Bank. Silicon Valley Bank was technically at about $211 billion of assets under management, under the 250 statutory systemically important bank requirement. Of course, they still ended up getting the unlimited FDIC bailout, and we could talk about the moral hazard of that in a different video. But more importantly here, Credit Suisse clearly above 250 bill. However, this is a Swiss bank, not an American bank. So what would the European Union or potentially Switzerland think about this? Well, their largest shareholder thinks, sorry guys, not interested. Good news though, Switzerland's central bank has swiftly entered the scene, and Switzerland's central bank is bailing out Credit Suisse if necessary. That's right. If you signed up for life insurance, it's probably still a good thing to have. Metkevin.com/life. You could do that within as little as 5 minutes, but listen to this. Credit Suisse Group AG will receive a liquidity backstop if needed. This is according to Bloomberg just minutes ago, seeking to restore confidence in the troubled lender after a record slump in its shares. Credit Suisse, after all, was down as much as over 30% in pre-market. Percent today in Zurich trading, it was down as much as 31%. Ended the day in New York down about 14%. And so clearly some of that bailout helping. Of course, this bank, a lot of bankers are saying this bank is different. This is not Contagion. Credit Suisse had poor management. After all, they lent to Archegos, and they were exposed to other potential, bad deals, basically, and bad risk management, and the blame is on them. But anyway, the government, central bank, and FINMA have been discussing ways to stabilize the bank after a tumultuous day sparked by the firm's largest investor ruling out increasing its stake. The Treasury Department in America earlier mentioned that they were now actively monitoring the situation with Credit Suisse. This was a big deal. Obviously, at this point now, after this bailout, it's a backstop. There is technically no bailout right now. It's just them saying, look, we'll provide whatever liquidity Credit Suisse needs, which basically is a fancy way of saying, look, if people want to withdraw their money from Credit Suisse because they're panicking and we end up having a bank run or whatever, fine, we'll backstop them. So what do we have here? Let's see. In a recent interview, the chairman of the Saudi National Bank stated he had no intention of increasing its 9.9% stake. Fine. But that 9.9% stake is probably lower now, given all the pain it's had. In an attempt to calm markets and restore confidence, Credit Suisse has appealed to the Swiss National Bank for a public show of support, which it has now received. The CEO of BlackRock, Larry Fink, also warned this morning of more seizures and shutdowns coming in the financial sector. That really this is just the beginning of the crisis that we are facing. That's scary, obviously, because it reminds us of the 2008 financial crisis, banking crisis, very bad. Larry Fink says we are going to see a lot of idiosyncratic events taking place. That's a fancy way of saying we're going to see a lot of individual banks get screwed, whether it's because of crypto or because of a lack of regulation or a lack of risk mitigation. Who knows? The good news is you can still get that St. Paddy's Day coupon code linked down below. Look, everything's green for St. Paddy's Day today. That was totally planned. Anyway, you get lifetime access and the best pricing guaranteed going forward. And you get lifetime access to the course member live streams. Anyway, as a result of the Credit Suisse crisis, projections for the monetary tightening have now shifted. For the first time today, well, actually, for the first time in this cycle, we are now seeing pricing for the Federal Reserve at a greater likelihood of a 0% hike compared to a 25 basis point hike. Now, this could have shifted just since we do have this breaking news here. It takes a little bit for the markets to react, so this could shift a little bit. I would say we're probably at a coin toss of 25 BP. A lot of people asking what my opinion is. I know it was 52 for 0 and 48 for 25 earlier. Personally, I think let's just be clear. Let's rule out a 50 BP. Let's rule out 0. Let's rule out negative a cut. So let's rule out the high side of 50. Let's rule out a cut. We could rule both of those things out. Now, markets are pricing in 100 basis points of cuts by the end of the year, but not yet. We're really debating, is the Federal Reserve concerned enough about this financial crisis, this banking crisis, this liquidity crisis, that they end up pausing? That could actually end up being bad for markets. Ironically, that could be a sign that things are so bad that they need to U-turn. That means they've broken too much. If we get 25 BP, in my opinion, it's actually bullish to get 25 here because it means your contagion risks per the Federal Reserve, which, remember, they have access to all this bank data way more than we do. I mean, they have 2,000 economists that work at the Federal Reserve. Not saying they're always right at what they do. I mean, they still manage to get things wrong, like they're still printing money when inflation is over 6% in March of 2022. But then again, maybe that's just Jay Powell's fault. No, I like Jay Powell. I don't want to say that. But anyway, we did see a lot of fears of contagion spread throughout the market today. We did have First Republic stock and a lot of the smaller banks trade down throughout the day. Of course, this bailout definitely helped buoy some of the losses a little bit, but you were getting a lot of fear that, even though we've got that FDIC bailout of $125 billion with the Fed, is that going to be enough? Now, the Fed didn't tell us. Usually the Fed will tell us, hey, we're going to leverage this or not. That's actually something they usually do. Look out the window, by the way. Doesn't that look cool? Anyway, usually they say we're going to leverage the... Oh, that's a dam. Usually they say, damn. Usually the Federal Reserve will tell us, we'll leverage this $125 billion bailout facility 10 to 1 or whatever. That's what they did during COVID. They didn't tell us whether or not they were going to this time. According to JP Morgan, that's actually a way of them going, hint, hint, we can do whatever we need to do without being blunt about it. This looks beautiful, man. Okay. And then The Economist, by the way, stating now that regardless of what happens with Credit Suisse, The Economist says we are entering a new phase here in which the Fed's tightening cycle starts to bite. The phase is characterized by markets working with the Fed instead of against it. Silicon Valley's bank collapse has shocked markets into doing the Fed's job of tightening financial conditions, such as lending standards, tightening lending standards. You're seeing that especially in auto. You're going to see that as well in home mortgages as well. Even as rates come down, lending standards might actually tighten substantially. Interest costs, money market liquidity, reduced aggregate demand, cooling prices. You create fear, right? When you create fear, people stop spending money. The Economist also noted tension between the Fed's inflation target and its duty to protect financial stability. Exactly. That's what we're sort of evaluating now is what's next, what's going to happen. Are we going to get 0 or 25? Is Credit Suisse too big to fail? Well, according to the Bank of Switzerland, the answer to that is yes, it is. It is considered a systemically important bank, and it is getting a liquidity bank from the basically the Federal Reserve of Switzerland. The ECB may even adopt a more cautious stance going forward towards hiking. They were widely expected to hike about 50 basis points. Now we're looking at probably a 25 BP hike from the ECB instead of 50. We also have, let's see, a little bit more information here. This is all CEO's efforts to reassure investors. That's boring. First Republic Bank was downgraded to a junk rating by S&P and Fitch. Well, duh, I wouldn't touch these things with a 10-foot pole. The only way I would play these right now, like the little banks, is I would trade them. Oh, dear. I would trade them. That's the only thing I would do. There's no way I would buy and hold these smaller ones. I wouldn't be surprised if we end up getting, honestly, hundreds of small bankruptcies. I think there's going to be so much consolidation to the big ones because nobody's going to want to take that risk anymore. Yes, we technically have the unlimited FDIC bailout now, but what happens if that unlimited FDIC bailout goes away? Anyway, now I'm checking out Austin. Quite literally right now checking out Austin. We're basically looking at the floor over here. Oh yeah, turn it a little more. Yeah, look at that. This is how we look at real estate. Anyway, I want to be very clear that I pay for this, not HouseHack or the HouseHack investors, and that is a guarantee I give you, as well as subject to our audits. HouseHack has paid $0 for this plane. That's because I pay for it. But anyway, that's my way of doing my best to make sure I'm the best CEO for this company. That looks beautiful out there. But anyway, so... wow, I'm really surprised. Credit Suisse is officially bailed out. I think we should wrap up on saying we've got probably... okay, let me put it this way regarding the Fed. Get your coupon code. Get your life insurance at mettkevin.com/life, and make sure you get your 12 free stocks at Webull by going to mettkevin.com/free. Okay, once you do that. So my thoughts on the Fed, I really do lean towards the idea that the Fed will go 25. I actually agree with BlackRock's CEO, Larry Fink, that these are going to be idiosyncratic risks. Fancy way of saying individualistic, right? Individual companies are going to fall off the shelf. They're like going to be, they're little, like, let's say you got a bunch of flies floating around in your house, and they're all banks. They're all little vulture, all little vampires trying to suck your blood, little mosquitoes. And the weakest of them are just going to go bankrupt, but they're not going to kill you. You're still going to be there for the other banks to suck on. And I think the other strong mosquitoes will survive. And I think the Fed realizes that. So not only does the Fed realize that, but I highly expect a 25 BP hike. Let's get to where we were thinking, 4.75, maybe even 5, maybe another 0.25. I don't think they want to send the signal of panic, but I think the pause is imminent. I don't think we're going as high anymore as previously thought. I think 6 is out of the question this year. This cycle, I don't think we're getting to 6 anymore after now we're starting to break things. But can we knock on the door of 5? Yeah, absolutely. Again, they do not want to send a signal of panic. Unless they do, you know? I mean, if they do, it's a sign that they actually do have some concerns about the banking stability. And that's a sign that the bank runs could be continuing even with the unlimited FDIC bailout. So personally, I think that's that 0 would be more scary to me, ironically. I mean, I think everybody generally cheers for, like, less. Now I think, quite frankly, we kind of want to be cheering for 25. And right now, the way the market's pricing it is a coin toss. I will say, though, what we got from PPI this morning, what we got from retail sales, was very good. Retail sales, we barely got adjustments from January. There were some course members this morning asking me about, hey, you know, what's your take on the adjustments for January? The adjustments for January were nominal. And I think a lot of us were thinking that, oh, you know, the numbers are all cooked and rigged. We're going to get massive adjustments. We barely got... gosh, Austin's beautiful, by the way. Look at this. We barely got adjustments for January. Barely. I mean, I think retail sales, for example, went from 3% to 3.2, super nominal adjustments, less than 8 to 10% in terms of adjustments, not actual percentage points. Super nominal adjustments actually beget accuracy in the January numbers. And they reiterate what I've been saying, that and this is not trying to pat myself on the back, it's just to be consistent here. And I'm not going to be consistent for the sake of being consistent. It just is what it is. Anyway, this reiterates that January was an outlier, that the retail sales for January were due to a warm January. This is not some kind of re-explosion of people going nuts spending money. Yes, people are still spending through this recession, but to some degree we want retail sales to be relatively stable so we can avoid a recession. Remember, the consumer drives about 72% of our economy. It's the opposite in China. Consumer only drives about 30% of the economy, although they hope that this year maybe the consumer will drive a little bit more, but we'll see. China's a whole nother story. I think the Chinese consumers are a lot more skeptical than American consumers are, as they should be. I mean, what they went through here with 3 years of lockdowns, folks. Absolutely insane. But anyway, say hello to Austin, Texas. We got the Gigafactory somewhere out here, but right now it looks like I just got Elonville. Not really, but this is us coming in for a landing. We get to enjoy it together. How about that? So, kind of cool. You can actually see the cockpit up here. It's also kind of cool. But yeah, this is breaking news. It's actually broke. I was downloading news stories, and this broke as we were taking off, and I'm like, oh, all right, now we're landing. So there you have it. Hopefully that was insightful. I think this is very good news. And bottom line, bailout, not a surprise from the Swiss bank. some of these guys are going to go bankrupt, and I think they need to, according to capitalism. I don't think it's best that we always have unlimited bailouts. At some point, it has to stop, but at least we have relief on the inflation front. So the volatile Nike swoosh continues, and I'm still bullish. If you want to ask me questions directly, join the course member live streams. I know this is an uncertain time, but if you want to get the first heads up for when we start buying real estate and when we, anytime I flip-flop, links down below. You get lifetime access. You join one of them, you get lifetime access to basically a course member live streams, which is awesome. All right, folks, I'm in Austin now. Thanks so much for watching, and we'll see you in the next one. Bye.